on strategic financial management. And for those who are just joining us for the first time, my name is Ibrahim Akindele, and I and Mr. Maruf Ajibala, right, we'll be taking a strategic case study, strategic financial management, right? So I will take the 70% of it, while my boss will take 30% of the syllabus. So for those who are just joining us for the first time, you're welcome to Next Gen Professional Associates. Please, am I audible enough? Because there's actually a code here, so I don't know if I'm audible.
Yes, sir.
Yes, I'm very audible.
Okay. That's fine. Thank you. A minute, please. A minute. Please, can someone just give us an overview of what we discussed in our previous class? Please, can someone just give us an overview of what we discussed in our previous lecture?
We discussed the project specific cost of capital. Project specific cost of capital and the procedures for calculating the specific cost of capital. That is the project specific cost of capital. The first thing is to identify the proxy company. And after identifying the proxy company, we calculate the asset beta by ungearing or removing the financial risk of the proxy company identified. So after that, we regear by including the financial risk of the main company. That is calculation of the equity beta. So you give us the formula for calculating that as well. Then having done that, we now use the two values gotten from the gearing and regearing. That is to calculate the CAPM. We calculate the cost of equity using CAPM. That is the KE plus the formula. You give us the formula. And having done that, we now calculate the weighted average cost of capital.
Okay, that's fine. Please thank you so much, Abdurrahman, for the overview of what we did in our previous lecture. Please can anyone just give us, why do we have to use a project-specific cost of capital? Why? Can just explain to us who can assist us with that? So why should we have to use a project-specific cost of capital to discount our projects? Why not using the normal cost of capital? Why project-specific cost of capital? So who can explain that to us?
I think the reason why we use a project-specific cost of capital is the company, for instance, now if the company is trying to diversify, going to another line of business, the risk they might be facing in the old business might be different to the new line. So they have to use, the risk that is associated with the new line of business.
That's a very good one, and that is what I want to hear. Thank you so much, Wale. So that shows that you're actually following the class, right? Makes sense. Okay, so we'll continue with our lecture, right, on project specific cost of capital. Class, last class we actually solved a question, I think an example, right? But today we'll continue with that. Please, you should don't forget that project specific cost of capital or appropriate cost of capital or risk adjusted cost of capital occur when a company is diversifying. When company is what? When company is diversifying, in the sense that you are into one line of a business and you want to go into another line of a business, you have to consider that risk, which is what? The business risk in that particular industry. And you should not forget that I gave 5 steps, right? That 5 steps is very important. Please. The 5 steps in calculating the project specific cost of capital is what is very, very important. Now, let's quickly look at this example. We've not started question. All this one is just an intro questions, right? Now, we should not forget our principle. And what is our principle is that, Sonia, please, can you mute your mic? What is our principle? Our principle is that you should read the requirements. Because when you read the requirements, research shows that when you read the requirements, right, it assumes that you have solved 60% of the question. So for you to understand the requirements, and I think you should be able to do it, solve the question. That is one thing I want you all to know. You don't just rush to question. When you see a question, first, calm down. Read through the requirements from 1 to 7. Then look at it. Okay, which one do you want to start with? Right? Of course, you should not start with question 1. Look at question 7. Look at question 6 that you can do. Right? So please, the requirement of the question is very, very important, because when the examiner say A and you are not doing B, right, they will not mark you, right? They won't. So please, understanding the requirement of the question is very, very important. Class. Now, look at this. Let's quickly look at this requirements. Class, we need to solve at least 3 questions today. 3 questions, right? The questions are adopted from ACCA, Ican, as well as other relevant tests. Now, required. Recommend a suitable discount rate for Project Hope. Suitable discount rate, right? Recommend a suitable discount rate for what? For Project Hope. So you should recommend. So it could be that maybe they want to go into another project. We don't know, but let's read. But this has already given us where we are heading to already, right? Now, can someone read for us? Please, who will read? Where is who will read, please? Okay. KKPLC is considering Project Hope. Can you see? KKPLC is the main company. It is not considering Project Hope. KKPLC has the following financial data. Can you see the financial data of KKPLC? This is the financial data of KKPLC. KKPLC is considering Project Hope, which means that Project Hope is actually another project entirely that is different from KKPLC, right? Now, KKPLC has the following financial data. Can you see it? The financial data, the cost of debt after tax, the cost of capital, equity beta, asset beta. Company gearing by market value. This is the market value. The market value of equity is 76%. The market value of debt is what? Is 24%. You also have the following financial data of PKPLC, a company in the same industry as the new project. Class, can you see? The question will always give you the proxy company. The question, in the question, you will always see it. You will see it in the question that, oh, KKPLC is considering new project, this thing. Oh, could be that they want to diversify. So the PK, look at, you can see that this is the PK financial what? PK financial what? Information. Can you see? The equity beta, the asset beta of PK, which is the proxy company. Now, the market return is 15% per year, and the risk-free is 6% per year. The tax rate is 25% per year. Required. You already know that this is project-specific cost of capital, since you have a proxy company. However, you have to calm down and read the required, right? The requirement. Now, recommend a suitable discount rate for project O. They did not say, the question did not say, oh, calculate the risk cost of equity so that you will stop in cost of equity, you know, from our steps. Now, they say suitable discount rate, which means that you have to complete everything. You have to calculate it to the, what? To the weighted average cost of capital, right? Now, so number one step, suggested solution. Step one. What is the proxy company? What is the name of the proxy company? What is the name of the proxy company? PKPLC. PKPLC is the proxy company. Step two, right? We have to do what? We have to ungear by removing the what? The financial risks, right? We have to do what? We have to ungear. So I can just copy this, right? I can just copy this and so that we can move. After the ungear, right? Now, that is calculate the assets better. Now, in the question, are we given any better depth of the proxy company? Don't forget, all this information are for the proxy company. Now, check. Better depth of the proxy company, is it given? This is the information of the proxy company. Can you see it? Can you see the information of the proxy company? You can see you have equity. You just have equity. Asset better. No better debt. Is there any better debt?
No, but they give us assets better. Do we still have to ungear?
They give us assets what? Asset better. Okay. Thank you. Thank you so much. I like that. Makes sense. Now, instead of us to calculate the ungeared, right? The asset beta is given to us already. So we need to save our stress. We need to save our energy for something else. First, this step two is to calculate the asset beta of the what? Of the proxy company. But the asset beta of this proxy company is given to be 1.2. Thank you so much. Thank you so much for that. Makes sense. The asset beta is given already, right? So we don't need to calculate the assets beta. But in a situation whereby most times, this is just a small example, most times the asset beta of the proxy company will not be given to you, right? Will not be given. Please just take note of that. Will not be given to you, right? This is just simple illustration. Now, the asset beta is given, so we don't need to calculate. We just say BA equals to 1.2. This is the assets beta. Class. What is the next step? Step 3. What is the next step, class?
To regear.
So we have to regear, right, by including the financial risk of the main company, right? The T is calculate equity beta. The T is calculate equity beta. Class, you should not equally forget that this part represents the proxy company. This one I highlighted here represents what? The proxy company. Why this is for the main company. Can you see main company? This is the business risk. Why this is the financial risk. Mary, you can mute your mic. Okay, thank you. Right, you can see that is the reason why you should calculate equity better, so that you will have both business risk and what? And the financial. This is the financial risk of the main company, and this is the business risk of the what? Of the proxy company. Right. So our BA, we have our BA of 1.2, BD, which is the better debt. Now the better debt of the main company is better debt of the main company given to us in this question. Do we have better debts? We have assets better. We have equity better. There is no better debt. Do we have better debt here, class? Class, do we have better debt of the main company?
No, sir.
Okay.
No.
Okay, thank you. So therefore, the better debts will be 0. Right? Now, for you to get your value of debt and your value of equity, we're given value of debt. Don't forget that you use level of gearing given to you, right? And this, they've already identified that the market value of equity is 76, right? The market value of debt is what? Is 24. So 76 is for equity. This is 24. This is for equity, which is 76. What is the tax? What is the tax rate of the main company? What is the tax rate of the main company? They just give us only one tax. Sometimes you may be given the tax rate of the proxy company as well as the main company. So since they just give us this only one tax rate of 25%, we assume that the tax rate of 25% will be for the two. So we can now have 25% as what? As our tax rate. Class. So therefore, what is the equity beta? You can copy this. Equity beta equals to 0.25. 0.25. Please, I need final figure. This is 0. Right. This is 0. So value of debt is 24. 1 minus tax rate. Excuse me. 1 minus tax rate, which is 25. Value of equity, 76. Please, what is the equity beta, class? What is the equity beta?
The B is 1.2, not 0.2.
0.2.
Okay. Thank you. 1.2. 1.2. Thank you. So what do we have, class? This is already 0. So we need to have 1.2 plus 1.2 plus, what do we have there? Who will give us figure now, please? We have a long way to go, please.
Total is 1.4.
3 points.
No, total figure is 1.48.
Okay, thank you. 1.48. Please, someone should confirm that. All right. What is the next step? What is the next step?
CAPM. Calculate the CAPM.
Step 4 is to calculate CAPM. Cost of equity equals to risk-free, right? Risk-free plus equity beta that include risk, market return minus risk-free. Don't forget, if you are given risk premium, right, you will just use your equity beta times. So there's no risk premium. Market return is what? 15%. Risk-free is 6%. So risk-free, cost of equity that will include both financial risk and business risk, right? Risk-free is 6%. Equity beta is 1.48. Market return, what is our market return? 15%, right? Minus risk-free. So what is the equity beta? What is the
19.
Okay, makes sense.
19.3.
Okay, 19.3 is the equity beta. Is the cost of equity. Makes sense. So cost of equity, 19 point what? What is the cost of equity? Okay, 19.32 or 19%. All right, let me confirm the market return. Okay, it's 15%. Okay, so that makes sense, right? That's what that makes sense. So what is the next step? The next step is to determine. The next step is to determine what is the equity beta. Is equity beta 1.48 or 1.44? So can we move ahead? Shay is correct, right?
Yes, it's correct.
Correct,
Okay,
correct.
okay, that's fine. Okay, that's fine. That's fine. So let's quickly move ahead. We can say this is all 19%. So the next step, which is step 5, is to determine the weighted average cost of capital, WACC. You can use the 1/r total or you use this method. Class, the value of equity times cost of equity, right? I don't want to copy the formula so that at least I know you'll have, okay, or should I copy it? Okay, let me just bring it this way. Okay, let me just copy it so that we'll save time. Weighted average cost of capital, right? Cost of equity, value of equity times cost of equity divided by value of equity. You can also use as total, still get the same what figure. So we can have weighted average cost of capital, right? Oh, okay. Don't forget that all this will be for the main company class. All this will be for the what? For the main company, which that is what we have examined. We've done that before. We'll find the value of equity, value of debt, and value of equity already. So let's just highlight them out. Let's just bring them out. Or let me just copy this so we can move. All right. So, okay. So value of equity of the main company. What is the value of equity of the main company? Value of equity, done that before. I think it's 76%. Value of debt is how many percent, class?
24%.
Just copy what just copy what you have here. You can see value of debt. This is for the main company. Just copy it. Bam. Repeat it like that. It's 24. So what is the tax rate? What is the tax? What is the tax, self? 25%, right?
25%. Yes.
25. So what else again? Okay, cost of debt, cost of equity is 19% that we calculated, or 19 or 0.19. Now, what is the cost of debt? Now, let's check from the question. Is the cost of debt after tax or post-tax? So let's check from the question. Okay, we have cost of debt after tax. Can you see it? The cost of debt after tax is 8%. Class, cost of debt after tax is 8%, is after tax. So you don't need to include that 1 minus T. So it is only when it is pre-tax. It is only when it is pre-tax. That is when you will now say, oh, 1 minus tax rate, so that there will be a tax relief on the cost of debt. Don't forget, under the debt, there will be a tax relief on it. So in this case, where we have this to be post-tax, after tax, they've charged tax already. They've given them the relief already. So you don't need to do 1 minus tax rate. So this is all 0.08. Right? So we can have here value of equity 76, cost of equity 0.19, value of debt to be 24, value of equity 76, right? Value of debt to be 24. So the cost of debt times, it is not plus, so sorry, from the formula, it's times, so I think I wrote plus something. It's multiplication, sorry. I think someone actually corrected me last night as well. So this should be times, right? So what is the cost of debt? 0.08. So what is the value of this? Is 76 plus 24. Sir, please, what is the weighted average cost of capital? Final figure, please.
16.2.
Thank you, sharp. Makes sense. Equals to 16 point what?
4.
16.4%. 16.4%, right? Is our what? Is the weighted average cost of capital that will include both what? Systematic risk and the financial risk. Can you see it? So when we get to investment appraiser, we'll be saying something like this, that we need to discount project. When we need to discount a project, from the question, if the company is diversifying, it means that we are going to use the weighted average cost of capital, the project specific cost of capital approach, the appropriate cost of capital to discount that project because the company is diversifying. In that same question, when we look at it that, oh, there's no any form of diversification here, meaning that what you will use to discount it, it is just the usual, the normal weighted what? The normal weighted average what? Average cost of what? Capital. We will get there, right? We will actually what? Get there. So thank you so much. I think I've any question on this before we move? This one is just, we are just coming, we've not done anything. Let's quickly look at this question. This question is adopted from Ican as well as ACCA, right? And don't forget that when I give you question to solve, please make sure you go back and do it. You get why, right? It is not just that I just go to one place and pick up the question. It is part of the research work I do on diet, right? So please, your assignment, please make sure you do it. Post your questions to the platform. Let's see, and your suggested solution. So wisdom. Wisdom. Okay, just put down your hand. I guess it's a mistake, so just put down your hand. Okay. So, Zeco PLC. Can someone read the requirement for us? Let's see. Who will read for us, please?
Required. Can I go ahead?
Please go ahead.
Okay, required. Using the capital asset pricing model, calculate Zeco cost of equity and a project specific cost of equity suitable for the new venture. Roman figure 2, referring to your calculation above, comment briefly on the view of the company of the commercial director, on the view of the commercial director. B, discuss 3 problems Zeco PLC may be facing as a result of its high level of gearing. Then C, in respect to both equity and debt, discuss the risk. Sorry, my screen keep moving up and down. Sorry about that. Okay, C, in respect of both equity and debt, discuss the risk return relationship and how it affects Zeco PLC financial costs.
Thank you. Thank you. Total marks allotted to this question is 20 marks. So you can mute your mic, please. You can mute your mic. Okay, total marks allotted to this question is 20 marks, right? Now, when you read the first required, using the capital asset pricing model, calculate the Zeco PLC current cost of equity and a project specific cost of equity suitable for the new. So you should know that, yeah, the first one you have to calculate is just the company capital asset pricing model without adjusting for risk. Why? And a project specific. So that is when you will now do your project specific cost of capital of equity. You will start from your step 1, step 2. They say project specific cost of equity, not appropriate cost of capital, meaning that after you calculate your cost of equity in step 4, so you don't need to move to the next step again, which is the weighted average cost of capital. You just stop from there, right? Because it is project specific cost of equity only. Stop in equity, right? 6 marks. Now, okay, the main question. Okay, Zeco PLC is a listed company in the house construction industry. Over the past 5 years, results past year results have been disappointing, and as a result, the share price has fallen from high of 3 naira 50 kobo per share 5 years ago to only 1 naira 5 kobo per share today. This deterioration in the performance and share price has been accompanied by an increase in financial gearing to a high level. Of course, when a company has an high level of gearing, it will affect the share price, meaning that investors will not be willing to invest in that company, because you should not forget that they pay debt holder before the ordinary shareholder. When we get to reconstruction and reorganization, right, we'll talk about reconstructed company and reorganization. But what I'm trying to explain here is that if you have high level of gearing, a company that have a high level of gearing, an investor, an ordinary shareholder will not want to invest in that company. meaning that you have profit before interest and tax. You remove the finance cost, you have profit before tax, right? You can see that you've already make a provision for finance cost. Then when you remove your tax, the net income, that is what the investors will share. Now, the company will now say, oh, since we have profit of 20 naira, now we need to pay, we'll pay dividend of 2 naira, right? We'll pay a dividend of 2 naira. But in a situation whereby if you're an investor and you see that the company profit is 50 naira, right? And they are paying, then they want to pay dividend value of 100 naira. Where did they want to see the money? Imagine your profit is 50 and you want to pay dividend of 100 naira, right? These are the things that we look at when you want to invest in a company. That one is by the way, actually. But what I'm trying to explain here is when company level of gearing is actually high, definitely it will affect the share because investors will not want to invest in such what company. So can you see the financial information, the financial statement, the share capital, the retained earning? Class, what are the sources of finance here? What are the sources of finance for the company? What are the sources of finance for the company from the financial statement?
Share capital, redeemable loan notes, and bank loan.
Redeemable loan notes, 7% back loan.
Okay, that's fine. Now, Zeco PLC loan notes. Zeco PLC loan notes are quoted at 65 naira per loan notes. When you say something is quoted, that is the market price, right? That is the market price of the loan note. It's quoted at what? At 65 naira per loan note, and both loan notes and the bank loan are what? Are secured. Class. Both loan notes and bank loan are secured. So when we still get to reconstruction, we have what we call secured loan and unsecured loan. Now, when they say something is secured, meaning that you must pay me, it is secured. There is a collateral to it, right? There is, because you will pay me back my interest and principal. That is what we mean, or that is what they mean by secured loan. They are both what? They are secured, right? The bank loan, the loan notes are quoted at 65 naira per, and both the loan notes and the bank loan are what? Are secured. Now, Zeco PLC equity beta is 2.3. You can see that when an equity beta is greater than 1, what is the implication, class? An equity beta that is greater than 1, what is the implication, class? Hello?
That means the stock is
It
volatile.
implies
The
that the
stock is
company's
volatile.
stock is risky.
Yes, it's volatile. Okay, it's risky. That makes sense. That makes sense. Okay, makes sense. Thank you. You are following. That makes sense. Now, new venture. This is the new venture. So this is where you know that, yes, there's kind of diversification here. Now, new venture. To improve performance, Zeco PLC is considering the construction of commercial properties. Such as office blocks and industry complexes. This is a new activity. Can you see? This is a new activity for Zeco PLC, and it is expected that the risk involved will be different from its current activity, of course. Now, the financial director has proposed that a project-specific discount rate should be used to appraise the new venture. Class, the financial director says that project-specific cost of capital should be used to appraise the project. But the commercial director, let's hear from let's see the view of the commercial director. But the commercial director does not believe this is necessary. You want to go into another new project and you say it is not what? It is not actually what? Necessary. According to the commercial director. Color commercial property undertake commercial construction projects similar to those being considered by Zeco PLC. Can you see? You don't forget that Zeco PLC is considering a new project. And you can see that color commercial property undertake similar projects that Zeco wants to venture into. So color commercial property here is the what? Is the Proxy company. Now, color commercial KCP as an equity beta. This is information for the Proxy company. 1.25. KCP has 100 million of ordinary share in issue. Can you see? Currently quoted at 2.60 kobo per 1 naira nominal value ordinary shares. Now you can see that as an ordinary shares of, this is the value of ordinary shares, 100 million. Okay, 100 million as 100 million of ordinary share in issue, currently quoted at, okay, this is for the Proxy company, right? The currently quoted at 2.60 kobo per 1 naira nominal value ordinary shares for the Proxy company. The company has 110 of loan notes in issue for the Proxy company. They currently quoted at 96 naira per 100 naira nominal value class, meaning that the sources of finance for the Proxy company here, you have ordinary shares, you have the quoted price, which is the market price, to be this, you have the nominal to be this. Now you have the debt, right, to be this. You have the current market price of the debt, which is quoted 96, with the nominal value of what? 100 naira. Now, both companies pay tax at 20%. The risk-free rate is 4%, and the expected return on the market portfolio is 10%. Required. Using the capital asset pricing model, calculate Zeco PLC current cost of equity. Class, the current cost of equity means that the equity will not involve any risk. Just calculate the current cost of equity without Zeco PLC. They are not talking about the projects, the new project. Just calculate the normal capital asset pricing model for Zeco PLC only. Class, am I communicating? Am I communicating? Suggested solution. Okay, that's fine. Suggested solution. Okay, suggested solution. Please always write the name of the company, Zeco PLC. This is very important. A Roma figure 1, right? So we need to calculate the company cost of equity without diversification. Class, without what? Diversification. Just the company normal cost of equity using CAPM. So cost of equity is equals to risk-free plus equity beta market return minus risk-free. Right. So what is the risk-free given to us in this question, class? Yeah, with the 4%. Question now. 4%. Thank you. What is the equity beta of Zeco PLC? What is the equity beta of Zeco PLC? What is the equity beta of
2.3?
Thank you. 2.3. 2.3. Equity beta of 2.3, right? 2.3. What is the market return, class? What is the market return?
10.
10%.
Someone say 10%. Someone, the other person say 5%. Market return is 10% minus risk-free. So what is the cost of equity of Zeco?
17.8.
17.8% or 18%. Now, Roman figure, still on Roman figure 1, right? Now, we need to determine the project's specific cost. You can mute your mic. Costs, project specific. You know, this is 6 marks. Now, this is how they apportion the mark. Oh, please listen. This is 6 marks. You see the cost of equity that you just calculated now is 3 marks. The project specific cost of equity is what? 3 marks. Total marks, 6 marks. Now, project specific cost of equity. Number 1 step. What is the project company? KCP. Is that not so? Is that not so, class? KCP is the project company, right?
Yes, sir.
Yes.
Yes, sir.
Okay, that's fine. I'm coming in minutes. KCP, step 2. Okay. I'll just copy. I'll copy the step 2. We regear, right? To save our time. Okay, thank you. So, cost of equity, step 2. We need to save time. Okay, let me just put it here. Okay. See this, please. Can you that's fine. Now, calculate the asset better. Don't forget that all this information will be for the project company. Now, do we have better debt? Before we move on, do we have better debt so that I will save my time? Do we have better debt of the project company? From this side, from this information, did they give us better debt?
No better debt.
Okay, no better debt. Okay. So better debt will be equals to 0. So I will save my time. So I don't need to capture these parts anymore, right? So I just need to save my time. Okay, so since this is not given, right? So better debt will be equals to what? 0. So we don't need this parts, right? Because better debt is not given. So equity beta of the project company. Let's quickly check. What is the equity beta?
1.25.
Okay, thank you so much. Can you see it, class? 1.25. Makes sense. Thank you. 1.25. Right. The value of equity of the project company. What is the value of equity of the project company? What is the value of equity of the project company? Don't forget that they have an ordinary share of 100 million. Then they have the market price. That is the quoted price of this. And per nominal value, 1 naira. And the nominal value is 1 naira. Please, who can tell me what would be the value of equity? We don't forget the usual way of calculating value of market value of equity. You can see now that this is not given in a percentage. This is not given in a what? In a percentage. Now, class, so how do we determine the value of equity now? How do we determine the value of equity, class?
That would
Ordinary
be
share is divided by nominal
100
value.
million divided by 100 times 2.6.
Okay, you say 100 million divided by what?
100.
Where did you see 100 to be
No, it's
nominal
Divided by
value?
1.
This is the nominal value. The nominal value is 1 naira. Look at it. The nominal value is 1 naira, not 100. Can you see it?
Yes.
Okay. You can mute your mic. Who is that now? You can mute your mic. Just mute your mic, please. Okay, that's fine. Thank you. Now, so can you see that the value of equity is not given in what? In percentage. So we need to calculate. So 100 million divided by the nominal value of 1 naira times what is the market price? Market price is what? 2 point what? What is the market price here?
2.6.
2.6
6.
2.6 naira per share, right? Let me put it per share, right? So what do we have? What is the value of equity?
Please, that 50 kobo in the question, what does it represent? That 50 kobo in the question, that 50 kobo per share nominal value, what does it represent, sir?
Where did you see 50 kobo? Where did you see 50 kobo here from the Fuzzy company?
From the his main company, sorry.
$260 million.
260 million. So value of debt. Value of debt. How do we determine the value of debt? It is not given in a percentage. How do we determine the value of debt? Value of debt, quickly, market value of debt.
We are going to use the same process.
110 over 100 times 9.
Divided by 100 nominal value times 96.
Okay, makes sense. Makes sense. Thank you so much for that. 110 million divided by the nominal to be 100 times. What is the current price, quoted price? What is the
96
quoted price?
96
naira per share. So what is the value?
100 okay, sorry. 105,600.
105.6.
105.6 million.
Yeah.
Thank you. So what is the tax? Both of them use the same tax. Both use the same tax. What is the tax rate? 10%. How many percent? What is the tax rate? 20%, right?
20%.
20%. Okay, that's fine. 20%. Right? 20%. So we can bring our formula to be here. Right? Equity beta of 1.25. Value of equity to be 260. Then value of equity to be 260. Then value of debt to be 105.6. So what is the tax rate? 0.2. Please, what is the final figure? No time. BA
1.1.
1.11.
0.94.
Which one is correct?
0.94.
0.9.
You can 0.94. Okay.
Yes, sir.
Where did you see 1.11? Madam. Away. Are you sure it's not your calculator? Are we on the same page? Are we on the same page? Okay. That's fine. Madam Sonia, you can mute your mic, please. Thank you. Now, After the asset beta, what is our next step? Step 3, right? We have to regear by including the financial risk of the main company, right? We have to regear for this. Okay. Now, if you want to regear, you should not equally forget that our BA is equals to 0.94 beta debts. What is the beta debt of the main company? Is it given? What is the value of debt of the main company? Is it given? What is the value of equity of the main company? Now, what did you notice in this question? Class, about the value of debt and value of equity. What did you notice? About the value of debt and value of equity. What did you notice in this question? Class. Hello? Hello, am I the only one in this class?
No, sir, no, we are together, sir.
The value of debt and value of equity are the same.
No. That is not. That is not.
We have two value of debt. We have two value of debt. We have the receivable loan note, and we have the bank loan. We have to add together.
Not that one. Now, the value of debt and the value of equity is not given in a percentage. Unlike the first one that we did, when we have debt to equity ratio, all this is given in a value. This is given in a percentage. If you look at this question, I'm just trying to expose you to the worst case scenario that you could see, right? In question, you may not be given that debt to equity or debt to debt plus equity. You may not be given, but you need to get the value. If the quoted price is given to you, the nominal, the value, the usual way we normally calculate the value of equity and debt. Please use it, right? Use it. Now, we should not equally forget that this is for the main company. Beta debt of the main company, value of debt of the main company, value of equity of the main company, although the tax is still the same, which is 20%. Now, let's quickly check the main company. If we have better debts. Now, can you see this is the information for the main company? Do you see any better debt here?
No,
Did you see any
No.
So better debt will be equals to what? 0. There is no better debt. Now, in another case scenario, right? In another case scenario, we have the value of equity. So how do we determine the value of equity now? How do we determine the value of equity, class? How do we determine the value of equity? How do we determine the value of equity, class?
Share capital divided by nominal value.
Okay, we give us the numbers of shares, okay, times what?
1.05.
Thank you. Times 1.05. You did see. Hi. Chop knuckle. Are you there? Chop knuckle. You did see. Maybe. Makes sense. Right? Times 1.05. Right? It is, see, this question, they intentionally put that price up so that you will not see it. Then you start looking for, where is market price? Where is market price? Where is market? You forgot that you've read it before that. Market price is now this. right? Market price is now what? This class. Now, are we still together, please? Now, that is how to determine the value. You can see that in this question, it is not the value of debt and the value of equity did not come in form of a level of gearing that they will tell you that, oh, market value of equity, the level of gearing or market value is debt over equity, or it is debt over debt plus equity. Now you have to determine the value. So you'll be looking for two things. Now, is either it will come in form of that percentage, or you have to determine the value. Please take notes, right? Take notes. Now, that will be the value of equity. So how do we determine the value of debt for the main company? How do we determine the value of debt for the main company, class? So how do we determine the value of debt of the main company? Hello? How do we determine the value of debt of the main company?
250 divided by 100 times 65 naira.
Times 65 naira. Okay, that will be the value of debt for the loan note. What would be the value of debt of the bank loan?
Same amount, that 20 million.
Thank you. Thank you. Thank you. Can you see? Debt. What debt do you have here? You have loan notes, you have bank loan. Now, loan notes is a traded debt. It can be traded in the market. If you want to get the numbers of loan notes, it is 250 divided by 100. We give you the numbers of loan notes. What is the current price? What is the quoted price? 65. What is the market value? Your answer. Now, you've gotten the value of debt. It is value of debt, class. Now, another debt that you have is bank loan, which is not traded debt. Now, you have to, don't forget, in our previous lecture, I said it, that the figure given to you in the financial statement, it is still the same thing as the market value of bank loan because it is not traded debt. Right? It is not what? Traded debt. So therefore, better debt is not given. 0. So value of debt, loan notes, please mute your mic. Loan notes equals to loan notes 250, right? 250 million. What is the nominal value? What is the nominal value?
100
naira times, what is the quoted price?
65.
65 what? Is it kobo or naira?
Naira.
Okay, let me check. 65 naira. Okay, that's fine. 65 naira. These are very technical question under project specific cost of capital. I have more than 1,000 questions in SFM. So we can always pick question. Okay, this will be the worst case scenario that Ican may set as question under project specific cost. We'll look at another case scenario. This is just one of the question. This particular question is just one of them. So what is the loan note figure?
163 million.
163 M.
163.
So, okay, 163. Okay. Don't mind me, not too much, Gary. Then the next one is bank loan. So the market value of the bank loan still the same thing as the figure given to you, which is 20 million. So what is the total? What is the total market value of debt?
183 million.
Okay. 183 million, right? 183 million. So this is the total value of debt. Value of debt. Class, who is against me in this class? I need to know the person that is against me. Who is against me? Are we still together, please? Okay, that's fine.
Yes.
So, okay, value of, we move. The value of equity. What is the value of equity? So, how do we determine what is the value of equity? Quickly, ordinary shares. 40 divided by 0.5. Okay. Mary, please give me. Okay,
80 million.
40 million divided by 0.5 times 1.05.
That's 1.05.
1.05. 1.05 makes sense. So what is the value?
84 million.
84 million.
84 million. Makes sense. You can see that the market value of debt and the market value of equity is not given in a percentage. In another case scenario, you will have the market value of debt is debt to equity. Debt over debt plus what? Equity. But in this question, you have to determine the market value of debt using the usual way, right? How to determine the market value of debt and what? And equity. So, what else? Okay, we are done. So let's quickly, okay. Okay. Okay, getting this. Okay, BA 0.94. This is 0.94. This is 0. The value of debt is 183 M. What is the tax rate? 0.2. What is the value of equity? 84 million. Class, what is the final figure?
2.5.
Equity beta is equals to 2.5. Is it 2.5? Is it ordinary 2.5 or 2.5 something?
2.57 or 2.6.
7. Okay, 2.5 says 2.57, right? Now, what is the next step? Step 4. Now, don't forget, the question says calculate the project specific cost of equity. It means that we will only stop in when we calculate, when we calculate the cost of equity, right? We will stop there, class. So step 4. Step 4. Cost of equity. This is the project specific cost of equity because it includes the business risk and the financial risk of the main company, right? So risk-free, is it risk-free? What is the formula? Is it risk-free? Okay, risk-free plus equity beta market return minus risk-free. So what is the risk-free given to us in this question, class? What is the risk-free?
4%.
4. What is our equity beta calculated in this question? 2.57. What is the market return? What is the market? Okay. So this is it. Can you all see it? This is market return. This is risk-free. 10%. Which is 10 minus 4. So what do we have? What is the cost of equity?
19.42.
19.42.
19.42%, right? 19.42%. So we are done with A, Roman figure 1. So this is 3 marks. So now 3 marks we calculate since. Interesting. Okay, this is just the 3 mark, right? Don't forget the total mark is 60 marks. No, 6 marks rather. The first one is 3, while the second is what? It's 3. So are we good? Are we good, class? Okay. Okay, that's fine. Okay, referring to your calculations above, comment briefly on the view of the commercial director. You'll be the one to comment on this. I will leave the comment for you. Comment based on what you calculated, referring to your calculations above. Don't forget, we calculate the cost of equity without including risk, which gives us 18%. Then we calculate the cost of equity, the project specific cost of equity, which gives us what? 19.4, which include both systematic risk and the financial risk of the project. Now, the question now says that you should comment on the view of the commercial director. Now, let's quickly read back. What is the view of the commercial director? The financial director has proposed that a project-specific cost of capital discount rate should be what? Should be used to appraise the new venture. But the commercial director does not believe this is necessary. Class. So the question now says that we should comment on the view of the commercial director. That is the view of the is the commercial director right or wrong? So who can give us? This is just 2 marks. So it's part of mark as well. Right? Whether the view of the director of the commercial director is actually correct or wrong. Yeah, now quickly.
Okay, let me try.
Okay, go ahead.
The commercial director, the view of the commercial director is wrong. Because when a company is trying to engage in another business, it is good that they try to compute the business risks of that company.
Okay.
So his view is not correct.
Okay. Thank you. Is there any other opinion on the view of the commercial director? Commercial director does not believe that we should use project-specific cost of capital, but the financial director believes that the cost of capital is appropriate. Quickly, class. Any other person?
Okay, to me, I would say the commercial director's view is kind of limited because he's not really grounded in the world of finance. as regard to the financial director, who knows that project specific cost is really appropriate because the new venture is carrying some elements of risk that are not familiar to the main business, to the Zeco PLC. So they need to compute the risk. That's this thing, the financial risk and the business risk of both the new venture and the old venture. So as regards to that, the
Thank
commercial
you.
director's view is limited.
Okay, thank you. So in addition, right? In addition, both of you has actually spoke well. Makes sense. So in addition to their comments, right? Okay, that way. Okay, so in addition to their comments, right? You can see the first cost of equity that we calculated is what? Is just, I think is 18% there.
18%.
No, it's 18%, which is lower than the project specific cost of capital of 19.7 or 19.8%. Meaning that indicating that if the company use that 18%, right, to discount the project, what it means is that they are overstating the project, they are overstating the MPV, they are overstating the project because it does not actually include the risk, which is the systematic risk. However, the view of the commercial director is wrong because in embarking on a new project, there should be a project-specific cost that will be used to actually discount the project. Using the project-specific cost of equity to discount is appropriate, indicating that there is high risk in that investment, and that investment has actually included the business risk, and it is evident from the calculation that the cost of the project specific cost of equity is greater than the normal cost of equity, meaning that it means that the project will actually include risk. Why the first one? If they use 19 point something percent to discount the project and they have a positive MPV, the shareholders will know that yes, this project have actually been discounted with the inclusive of debt, of of business risk. But using the cost of equity, the only cost of equity to discount, it will indicate that the investment would have been overstated because it does not include business risk. Overstated means that you collect salary of 50,000. If you look at it in money term, then if you are looking at it in money term, you are overstating that salary. But when you consider inflation of 22.2%, right, you will see that when you remove it, you know that yes, this is the real amount you actually earn. That is what it means actually. Class, am I communicating? Class.
Yes, is it, are you saying that the commercial director would have understated the profit?
Yes, you would have overstated, understated now. If you include, you would have overstated the project, which will not be appropriate because it does not actually include the risk. However, the project specific cost of equity that is greater than the normal cost of equity, indicating that the project has already include what is it called? Business risk that will actually affect the project. So shareholder is rest assured that okay, what they will get, this is what they will get because they've already considered what risk. Do you get? Are we still together, please?
Yeah, together, sir.
Okay, that's fine. Now, what is the next question? Discuss 3 problems Zeco PLC may be facing as a result of the current high level of gearing. Like I usually say, you don't need to cram SFM. You just need to understand it. That is when we doing intensive, you will still see more, not even doing it as we move self. You don't need to cram it. You don't need to cram their suggested solution. You don't need to cram their terms, but just understand why and the reason why we have to, so that you express yourself. In fact, these 2 marks, you can write and say, okay, I beg you don't do self. Since it is 2 marks, because you have understanding of that particular question. Not only that question, the topic itself. Now, the next question is 6 marks. Discuss 3 problems Zeco PLC may be facing as a result of its current high level of gearing. So, you can tell us 6 marks. One. Away.
First,
Investors will not have confidence.
Okay, one after the other. Esang, right? Okay, let me start from you.
Okay.
Okay.
The share price, it will affect the share price, and the investors will not have confidence to invest in such company.
Okay, as a result of high level of what? Gearing. Okay. Okay, that is 1. 2.
They will have challenge in assessing more loans, because since their gearing ratio is very high, no financial institution will be willing to give them loans. So, and that will affect their production also.
Thank you. Thank you so much. Thank you. Thank you. It will, because if your debt is actually high, to have access to finance will be very difficult for the company. That is their debt capacity. To raise finance will be very difficult for the company. Another one.
It could lead to
The company will incur high finance costs.
Away. Chidera.
Hello.
Yeah, I'm with you.
Yeah, I said that the company will incur high finance costs due to the high level of debt incurred.
Yes, someone have actually mentioned that. Okay.
Their
As a
equity
result of
invest. Okay.
Abbas.
As a result of high gearing, the equity investor will request for more of return on their investment.
Thank you. Thank you. Abbas, go and invest in AAPLC, and you look at the company that they are highly geared. Then be expecting 2 billion from your investment. Theoretically, that makes sense. Do you understand, Abbas? Theoretically, that makes sense. Do you get? That makes sense. So what again, please, so that we move. Bankruptcy, right?
Bankruptcy.
Yes, bankruptcy. That is a very good one, right? They could actually, as a result of, it may lead to a bankruptcy. One of the topic you will find interesting in SFM is reconstruction and reorganization, where we have to look at the bankruptcy act, whereby the company want to liquidate. Are they going? Should they consider reconstruction or they should liquidation? You know, if you are going for liquidation, who are the first people to be settled? See, there are so many things we need to discuss, right, under the reconstruction and reorganization. So bankruptcy. Tochukwu, lastly.
Okay, probably this is a question. Is there, due to the high level of gearing, is there a risk whereby the equity investors may receive little or no dividend payments?
There is now. There is. You should not forget that in our profit statement, you have profit before interest and tax. You deduct the interest. You are paying the finance cost. You have profit before tax. You remove your tax, you have the net profit. Then what remains, that is when you will now share to the equity investor. So if they have level of gearing, it is highly probable that they may not even receive any return on investment because of high level of what? High level of gearing. But that the company will face with a lot of risk because nobody will want to invest in such company. Do you understand? So this. Thank you.
Thank you.
Chidera, lastly. Yeah. Lastly.
Okay.
Chidera.
The company will face a higher risk when the interest rate increases.
Yes, exactly. Because exactly they will face. We are still talking about how they will raise the funds as well, right? That's a very good one. Okay, a practical illustration is the CBN MPR rate is about 27.9%, right? Now, bank will be lending at 30% basis point or 31% basis points. Normal, right? 30 to 32 basis points, normal. But when they now assess you and they look at it that you get plenty loan, no, they will increase the interest rates. Bam. So it makes this how to source for finance make it very difficult. It will make it very difficult for the company. Thank you. Next, C. In respect of both equity and debt, discuss the risk-return relationship and how it affects Zeco PLC financing costs. So someone will explain the debt and equity relationship with respect to risk and return. Then the other person should explain how it affects Zeco PLC finance cost so that we can close this chapter, right? So who can do that? Someone should explain the equity and debt to discuss the risk and return relationship. Of course, we've done that. We've talked about all these things at the beginning of cost of capital. I'm waiting.
The higher the risk, the higher the expected return. If the risk is high, the return is bound to be high. The return is bound to be high if there is return at all. Because of the high risk.
Mr. Abdurrahman, as being you are in examination or assuming you are writing the exam, can you?
Okay.
I think where you are is noisy. Just I don't know if we can.
Okay. You said if I'm in the examination hall.
Yes, please. We want you to just explain the way you will write it down.
Okay. The risk-return relationship and how it affects Zeco PLC financial costs with respect to both equity and debt. So I said the risk and return relationship, that the riskier the business, the more the return. that is expected.
Okay,
Maybe someone
that's
else
fine.
should try. No issue.
Okay, that's fine. That's fine. So any other? Thank you. That's fine. Any other contribution? Quickly. Quickly. Okay, that would be your assignment then. If you don't want to, just one person. Okay. Me, I will do me too. I don't know it. So let's just leave
Maybe
it as
maybe
your
as maybe let me say
assignment. Thank you.
something.
Okay, please say something. Thank you.
Yeah, we say that in the relationship between the equity and debt as regards to return.
Return, yeah.
Yes, I can say that equity is more riskier than debt, as we know that they are the debt holders. They are the ones to settle before the equity. I mean equity
Okay.
holders. So whatever that
Okay.
is left, whether maybe even when the company is going to liquidation, the debt holders must be settled. So whatever that is left, that will be settled the equity holder. So in that aspect, I can say that the equity holder is more risky than the debt holders.
Okay, thank you. That is a very good one, right? So in terms of risk, an equity holder, an equity investors, right? An equity investors are prone to more risk when it comes to investment in shares, and they higher the risk of the invest because of the risk they took, they higher the what they higher the return on their investment. However, on the debt holder part, right, they are not the risk taker, but they are not a risk taker. Then the lower the risk, right, of the debt, the lower the what the return. Why? Because the cost of debt is usually lower because of the what because of the tax rates included. So my take on this is equity holder that are faced with higher risk are expecting higher return. Why debt holder? Because why debt is usually what low, right? Because there is a tax relief on the debt as well, right? Then the return is usually lower than equity. A practical illustration is when it comes to bond and you come to equity shares. Is that not so? So that is it. And how it affects Zeco PLC financing cost. Class, how it affects, how does the equity and debt affect the how the company we actually source for finance? Now, in sources of finance for Zeco, because they are prone to high what they have high level of gearing. So in sourcing for finance, right, under the equity may be more expensive, right, because of the high level of gearing. The high level of gearing will lead to an increase in the what in the cost of raising finance under equity. Class will lead to what because they are faced with what high level of gearing already. So how they will actually source for their finance, it will what to actually what very very difficult for them, right? Because debt holder will be expecting their dividend. Their debt holder will be expecting their what is it called their interest and principal as at the what as at the date of what maturity. Thank you, Dari.
Sir, can you hear me, sir?
I can hear you.
You can hear me, okay. I was even looking at pushing the question specifically for this question itself, tailor it to this question. That's what I was having in mind. Because if you look at the Zeco PLC, before, if he did not go ahead to take over this new investment he's looking at, his cost of his a better equity was stood at 2.3. That is his risk. And by the time he now take over this business, as his plan using the project company evaluation. As at that time, it would have increased to 2.6 or thereabout. So for the business, by accepting the new business they are trying to look at, will definitely increase. But for the debt, it's a secure and it has a fixed amount based on the way it appears. And then even the cost of debt we are told is zero. So going into the new line of business or not going to it does not really have any risk.
Yeah, cost of debt is not assumed to be zero. You know, it is not zero, it's better debt.
It's better debt, sorry. So the risk associated with the debt is zero. Because they are fixed based on the way it appears there. So what I really see that really change in terms of Zeco here is actually the risk, the ABE, that's a better equity that has increased. And that is an increase from 2.3 to 2.6. Okay. And definitely that will also tell on their finance cost. It will also increase their finance cost will increase if they undertake this new project they are trying to bring into. Going to increase their cost of finance.
Thank you. Okay, thank you. Thank you so much. Thank you so much. Thank you so much for that brilliant explanation. That makes sense. Now, in addition to this whole lot on how it affects Zeco PLC, you should not forget that the cost of equity will be higher because of as a result of the high level of gearing. However, the cost of debt will also be higher as a result of the high level of gearing. Now, a practical illustration here from the question is where we have 6.5%. We have, can you see that we have 6.5%? Is that not so? We have 6.5% and we have what? 7%. You could see that the bank loan, 7%. The, what is it called? The redeemable debt. If you add all the debts together, what do we have? I think it's even more than what is it called? If you add them together, what do we have? I think it's about 17 thereabouts, right? Right. So the cost of debt will actually be higher than the debt because of the company high level of gearing. How they will raise funds will be very difficult for them. With that, company will be saying that, okay, we have to increase this, we have to increase the interest rates. They may, that is where you see the bank loan to be 7% now. When irredeemable debt that does not have MD, according to theoretically, right, you have 6.5%, while you have bank loan of 7%. Right. So thank you. Any other question, please?
My question is that all this formula for calculating on GR will be given to us in exam.
So if you can will be given to you. Okay, I can we give you, Mr. Abdurrahman. I can we give you. Guy, you better go cram. See, there's nothing in this one, honestly. If we solve like 2 to 3 questions now, you master all these things. So you master them. So can we move?
Hello, sir.
So we are done with this question.
Hello, sir. Hello, good afternoon, sir.
Yeah,
okay. Yeah, sorry. I had a question from the previous question you solved. Just that my settings had an issue. I couldn't unmute myself, so I've already fixed it. So I don't know if I can go ahead to ask the question concerning the previous question. That's a KKPLC.
Go ahead.
Okay, sir. The cost of debt after tax from the question, I'm seeing 6%. But when we started solving, I saw that we use 0.8. So I need clarification or more explanation on that, sir. Thank you.
Okay. So where did you see 6%? KKPLC. Where did you see 6%? on
They
the
said
cost of debt.
the following financial data, cost of debt after tax. Oh,
8%.
Oh, 8%. Okay. Okay. Thank you very much.
Do you have the question?
Yeah, it's like I made a mistake while copying it. I made a mistake. So let me correct it now.
Okay, well, that's fine. So we are done with that question, right? Abdurrahman, go and cram this formula. I don't know as you go to do am, whether you want cram am new, be whether you go dey inside bus, they talk gear and on gear. just just fulfill righteousness, right? Make you know I'm for head. I can we not give you anything, no. Not even think am. So the next question is also adopted from Ican&Acca as well as other tests. And don't forget, my questions are just okay, it is what it is. I won't say more than that. Okay, so just question 4. Do we still have time? Can we continue? Do we still have the energy? Let me see if we have the energy. Don't play. No, do we still have the energy? Should we continue? Okay, let's quickly I think we should, yeah, let's continue. Okay, that's fine. Mary, are you still in this class?
Yes, sir.
Okay. A minute, please. You just have 1 minute break. I'll be back shortly, please. Thank you. Okay. Hello. Are we still together, please?
Yes, we are continuing.
Okay, can someone read for us the requirement first? The requirement of this question first.
Required.
Okay.
Requirement 1. Determine whether 15% per year is an appropriate discount rate.
Madam Victoria, you're welcome. Welcome back.
Good afternoon, sir.
Good afternoon. Okay. Go ahead.
Okay, requirement A. Determine whether 15% per year is an appropriate discount rate to use for each of these projects. Explain your answer and state clearly any assumption that you make.
Wow.
Can
It's
I
in
read
maths. Yes, please.
Okay. It is TL's marketing director suggests that it is incorrect to use the same discount rates each year for the investment packaging as the early stages of the investment are more risky and should be discounted at a higher rate. Another board member disagrees, saying that distant cash flow are riskier and should be discounted at a higher rate. Discuss the validity of the views of each of the directors.
Well, 2 marks. So total marks here, 20 marks. So this is another question adopted from CCA and some other relevant tests, right? So you have 20 marks, right? Oh, okay. The first question is to determine whether 15% is appropriate discount rate to use for each of these products. We don't know what is 15% and how they arrive at that. 15% is appropriate. So for this project, so we need to read through the question so that we can where we will pick if it is actually appropriate or not. Okay. TPLC is evaluating 2 projects. Please, let's pay attention to this question. Please, let's pay attention to this question, please. Okay. TPLC is evaluating 2 projects. The first involves a 47.25 million expenditure on new machinery to expand the company's existing operations in the textile industry. Now, the first project is that they want to do an expansion, not that they want to diversify. If you are diversifying is into another line of a business, that is one part. This is not diversification. This is expansion, which means that the company level of risk will still remain the same because it is not diversification. It is just expansion of business. Class, am I communicating, please? Am I communicating?
Yes.
Yes, sir.
Okay. Now, the second is a diversification into the packaging industry. Now, this is the one that you will now say, oh, this is diversification. And we cost what? 92.75 million. 92.75 million, right? That is the second project. This is for diversification. And they want to evaluate the 2 projects, the expansion as well as what? The diversification. This will cost them this. The second one will cost, the first one will cost this. Now, TL's summarized statement of financial position as at 31st December 2022 and those AK PLC and LS PLC quoted companies in the packaging industry are shown below. Class, who is AK PLC and who is what? LS PLC. It means that if the company is diversifying into packaging industry, they have identified 2 companies, which are AK PLC and LS PLC. 2 quoted companies in the packaging industry. So this is the proxy company, why this is the main company. Class, for the diversification, which is the packaging what? Industry. Non-current assets, ordinary shares, medium long-term loans, total equity and liability. Class, what are the sources of finance here? What are the sources of finance in this financial statement? What are the sources of finance, class? What are the sources of finance? Am I the only one in this class?
Ordinary and long stock.
Current shares are medium and long term.
And the medium and long-term loans. Now, this question is a trap that they want you to attempt it. Because what is this ordinary shares for? Ordinary share price. You can see that this is ordinary share price. And this is long. Oh. This is loan stock price. This is what? Equity beta. Can you see? Now, this ordinary shares price that you see here, you have equity beta, you have long stock. Now, here you still have TL and LS 50 kobo par value, AK 25 kobo par value. Class, which one of these two is the market price and which one is the nominal price? Is it the 50 kobo that is the nominal price, or the ordinary share price is the nominal price? Which one is the nominal price? Which one is the market price, class?
50 kobo is the
50
nominal
kobo
price.
is the nominal.
Thank you. Because they've stated is par value nominal. This is the nominal value. This is ordinary share price. They say share price. That is the market price. This is the loan stock. This is ordinary share price per shares. 3 naira 80 kobo per share, 1 naira 80 kobo per share, 2 naira 30 kobo per share. Loan stock price. You can see the loan stock price, right? Per bond, right? Or per loan notes, right? You can see the equity beta 1.2, which is greater than 1. Now, TL 12% loan stock, 2027 to 2029. This is the interest rate on the loan stock. For TL, for AK, 14%, LS medium term bank loan, meaning that a medium bank, meaning that the 14% will be for the AK as well as LS, right? Or they didn't give us, okay, yes, it will be, because they're supposed to give us the rate for the medium term loan. It's not given, okay? That's fine. TL proposes to finance the expansion of textile operation. Don't forget that they want to expand the textile with 46.225 million up. So now, TL proposes to finance the expansion of textile operation with a 47.275. That is for the expansion stated above. They've stated it before. With what? Loan stock. That is debt. The expansion, don't forget that they want to evaluate 2 projects. The first one is expansion. The second one is diversification. The expansion will not change their risk because it is still normal, their normal business. Their risk will still remain. But they will now finance that expansion with what? With loan stock. And the packaging investment with a 92.75 million right issue. So this is right issue at a discount of 10% on the current market price. Now, meaning that what is right issue? I think one of the financial institutions is actually doing it right issue currently, right? And what is right issue? When you issue a shares below the market price or at a discounted price to the existing shareholder, right? That is right issue. Under the right issue, we have what we call do nothing. We have what we call sell right. We have what we call sell parts. you can decide to sell part of your rights and owed, right? I think those sources of finance has actually been moved to financial management. Would have look at the right issue, theoretical right price, and all that. Now, that is what, right? So it will not be financed by equity. The packaging, the expansion, the packaging will be financed by what? By equity. While the first one, which is textile, which is expansion, will be financed by what? By debt. Now, TL's managers are proposing to use the discount rate of 15% per year. This is how they arrive at their 15% in the requirement, right? Now, TL managers are proposing to use a discount rate of 15% to evaluate each of these projects. Of course, if you want to evaluate this project, you cannot assume the 15%. First, the 15% may be appropriate for the expansion that you want to do. May be, right? Now, the 15% will not be appropriate for the diversification because of the risk. You need to include what? The risk, right? Now, the risk-free interest rate is 6% per year. The market return is this. The corporate tax is 33% per year. And determine whether the 15% is appropriate discount rate to use for each dispute. So in order for you to determine if it is appropriate or not, class, you need to determine the project specific cost of capital up to the point of weighted average. Then you cannot compare with 15%. Is it appropriate? You now do your comment. You now explain. No, it is not appropriate because it does not include the business risk. So you will now still calculate the weighted average cost of capital for the textile, for the expansion. For the expansion is still their normal business. Their risk will not change. It is still, so you calculate the weighted average cost of capital, you now compare with 15%. Oh, you now use it to check. Oh, is it appropriate or not? Class, am I communicating, please? Am I communicating? Are we still together?
Yes, sir. We are together.
Okay, that's fine. That's fine. So the first one is for the packaging industry, for the diversification, suggested solution. Excuse me. So what is the name of the company? CPLC. What is the name of the company, class? TLPLC, right? This is very important. TLPLC. Diversification. There are two projects. Let's start with the diversification into packaging. Industry. So we'll identify the POSI company. Number one. So what are the POSI company, class? POSI company, class?
AK and LF.
AK and LF. Right. AK and LS. Now, class, in a situation whereby you have, what is the next step? In a situation where, like this, that you have two POSI company, right? What you need to do is that in a situation now that you have two POSI company, calculate the asset beta for AK. Calculate the asset beta for LS. Then look for the average. Add the two together, then divide it by 2. If you have 3 proxy company had their asset beta together, divided by 3. You have the asset beta of the 3 proxy company. Then you now move. You can now move to the next what? To the next step. Class, am I communicating? So in this case now, what is the asset beta? We need to calculate the asset beta for AK PLC and LS, so that we can quickly look for the average, right? The average. So now, before, are we given the better depth of the proxy company first? Any of the two? Let me check so that I will save our time. Better depth. Oh, is those equity better that is given? No better depth. So let me quickly save our time. All right. Let me save our time here. This is out. This is out of it, right? So which means that better depth is equals to 0. So we'll start with, let's start with LS or AK. Okay, let's say AK PLC, asset beta, BA. So let me start. What is the equity beta for AK PLC?
1.3.
1.3. Class, are we there? Class, are we still together? 1.3.
Yes.
I expect you to have your material as at now, please. Right? 1.3. Then the value of equity. You can see that in this question, we're not given value of equity in form of percentage or this. Let's check. Don't forget that this is for the proxy company. Value of equity. So let's quickly check. Now, how do we determine the value of equity here? Class, how do we determine the value of equity? Class, quickly. How do we determine the value of equity? For AK, how do we determine the value of equity? Quickly, class.
100 divided by 0.25 times 1.8.
Thank you. Thank you. Makes sense. Makes sense. So 100, is it a million? Divided by 0.25 times, what is the market price? Market price is what?
1.8.
1.8. 1.8. So what do we have here? What is the market value of equity?
720 million.
720. So we check for debt. Check for debt. All right. What is the value of debt? What is the value of debt? Quickly. How do we determine the value of debt here?
150 million
divided by
100 multiplied by 112.
Okay, where did you see 100?
We assume because it was not even, so we assume that the market nominal value is 100.
Okay. Why did you assume? Why did you assume the nominal value should be 100? What is the basis of your assumption? I want to stress.
A debt is normally traded within or close to the nominal value. And since the market value is 112, so we can assume that the nominal value is 100.
Okay. That's a very good one. And see, assumption is allowed. That is why they say state clearly any assumptions that you make, class. Since the nominal value is not given, you can assume that the nominal value, you can state it that assumption from the above analysis, right? it is assumed that the nominal value of the debt is 100. State your assumption and move on. It is allowed. Now, thank you. That is a very good one. 150 divided by, okay, you give me figure, right? Okay. 150 divided by the nominal value, assuming to be 100 times. What is the market price of the loan notes?
112.
112. Okay. Don't forget, class, don't forget that assuming there is bank loan for AKPLC, would have add bank loan to the market value of debt, just like the way we did in the second illustration. Now, if you look at this question, there's no bank loan. So would have add the market value of what? Of bank loan, just like the way we did in the what? In the previous what? The previous illustration. So what do we have here?
168 million.
168 million. Right. So what else do we have? What is the tax rate?
33%.
33%. Let me quickly confirm that. Okay. They just give us only one tax rate. So it's part of your assumption that, okay, this tax rate, it is assumed that the tax rate of 33% will be used for the three company. It's assumption. State it. So or 0.33. So therefore, right, here we can have this. So BE 1.3, value of equity 720, value of equity 720, value of debt 168. So the tax 0.33. Plus, what is the asset beta for AK? What is the asset beta for AK?
1.12.
1.12. So you calculate asset beta for a LS so that you look for the average, then you move. LS so the same thing, bring them out like this. What is the BE? What is the value of equity?
1.2.
What is the value of debt? What is the tax rate? The tax rates. So what is the equity beta? What is the equity beta?
1.2.
1.2. Okay, so let's quickly determine the value of equity for LS. So value of equity for LS, how do we determine value of equity for LS? Quickly. Market value of equity, quickly.
300.
Okay. Divided by
0.5.
0.85.
300 divided by 0.5. Okay. Times what?
2.3.
Times 2.3.
2.3. Okay.
Yes.
That's fine. 300 divided by 0.5, Abi?
Yes, sir.
Yes.
Times 2.3. So what do we have?
1380.
1380. 1380. Is this what we have?
Yes.
Yes, sir.
Okay. So what is the value of please mute your mic. Who is that? Let's see if she mutes your mic, please. So what is the value of debt?
0.
The value of debt. The value of debt is 0. Okay. Okay. So what is the value of debt? What is the debt? We have 150. This is 150. Is that not so? 130. Sorry.
130.
130. Okay. I'm coming. Just hold on. Okay, equity. Okay, this is debt. Okay. Okay, 130. Okay, what is the nominal price? What is the nominal price? Class, what is the nominal price? The nominal. Okay, 100 naira. Okay. 100 naira, that's fine. So what is the market price?
50 kobo.
No.
Why market price go be 50 kobo now?
Zero.
Nothing. It's 0.
Nothing.
It's a medium term draft loan. It's not your debt.
Now you cannot assume. No, you cannot assume. Now you cannot assume. Class, how many assumptions have we made? We have made like 2 assumptions. Number 1, the nominal value of the debt, it's assumed to be 100. Number 2, now we will now assume that the market price of the debt is assumed to be 100 as well. So therefore, what is the value of debt in the financial statement? What is the value of debt in the financial statement?
130.
What is it? Okay.
130.
Is what? 130. 130. 130. 130. So 130, right? Divided by the nominal value that we assume to be 100. You state your assumption times the market price. You can assume that the market price is equals to 100 as well. Or you use the value, you use the 130 given to you in the question as the market value of debt. Anyone. Either you assume the nominal value to be 100 and the market price to be 100. Or you assume that you stated in your assumption that the 130 million is assumed to be the market value of the what? Of the debt. Class. Of the what? Of the debt. So you can, whichever one you want to use, this will still give us what? 130. Class. This will still give us the what? The one what? 130. Whichever one. You can assume that the market value, the medium-term loan given to you in the question is assumed to be the market value of the debt. Or you say the market value of the loan note for LS is 100. Why it is assumed that the market market price is 100. So whichever one you can assume and you move on. So what is the tax rate? 33%. How many assumptions now? 3 now, right? So you can state it. It's actually what? Allowed. So I can bring my formula again. Right. I can put it here. So Value of equity. Value of equity is what of, I say value of equity beta, sorry, 1.2, right? Value of equity 1,380. Value of equity 1,380. Value of debt 130. So what do we have?
1.13.
1.13. Average assets beta is equals to 1.12 plus 1.13 divided by 2. Divided by 2, you have your asset beta. In a situation whereby you have more than one proxy company, you look for the average, then you get your what? BA. So what do we have?
1.125.
1.125. So before we move on, so are we on the same page? Before we move on, please. Before we move to the next step, are we on the same page? Okay. Fatai.
Yeah, so we do together.
Okay, that's fine. So just bring down your hand, please. Thank you. So after the asset beta, the average asset beta to be this, we have to move to the next step. What is the next step? Step 3. We have to regear, right? I don't have that energy to write. Let me just copy my regear. Thank you. Oh, I have to regear. Right. So the asset beta, don't forget that this is for the main company, this is for the proxy company, and this is for the what? The main company. So the BA is equals to 1.125. Beta depth, we don't know if the beta depth of the main company is given. The value of debt, the value of equity. So let's check. The beta depth is the beta depth of the main company given to us in this question. Beta depth. Can you see this is the main company, right? Did you see anything beta depth? I guess no. Beta depth is not given. If it is given, it would have been stated somewhere here. So the beta depth will be equals to what? 0. This will be 0. So what will be the value of debts of the main company? So the same way we did, that is TL, right? So can you see this is 560? Is that not so? So 560 divided by what? 0.5. Is that not so? Is that not so, class? Hello?
Yes, sir.
Okay. Times the market price of 3.8. So we go there 150. 150 divided by 0.5 times.
The depth is 560.
Okay, his value of
His value of
debt.
equity.
Okay, don't worry. Let me switch it. So what is the market price of equity? What is the market price?
3.8.
3.8. So what do we have here in total? What do we have here?
1,140.
1,140. So what do we have here as value of debt of the main company, which is TL? This is the debt is 560, right? So the nominal value will be assumed to be 100 times the loan stock price. What is the loan stock price? 104 per loan. So 560 divided by 100, which is assumed to be the nominal value, times what is the market price for the loan stock? 140, Abi?
104.
104. Okay. The loan. So what do we have here?
582.
582.4. 582. 582.
Yes.
Okay. So what next? Oh, I think we need to go. Since I'm tired though, I have to go. Okay, so let's quickly complete this part, right? All right. Okay. So BA is 1.125. 1.125. Beta debt is equal to 0. Then the value of debt, the value of debt, 582. Value of equity, 1140. Then the tax rate still remain 0.33. Please, what is the final figure here?
1.5.
Okay, equals to 1.5. That is equity beta. So what is the next step? Step 4. Cost of equity equals to risk-free plus equity beta market return minus risk-free. Cost of equity is equals to, what is the risk-free given to us in this question, please? The risk-free, okay, 6, thank you. And the market return, 14. Please, if you don't have the material, please make sure you get your material, okay? Please. So this is 1.5. Market return is 14 minus 6. So what do we have here? What do we have? What do we have? 18%. So what is the final step? Step 5. WACC equals to, let me save my time, right? Can actually write it, but I want to save time because kind of tired. So let me just save time so that we can move on. Where is it? Okay. Okay, this is the formula. I think I made mistake from the formula for, I think I'm coming. Let me quickly correct this. Oh, sorry, please. There's a mistake here. It's supposed to be times, not plus. This is supposed to be times, not plus. This is supposed to be times KD, please. The next step is that now. Dari.
Can you hear me?
I can hear you.
You know, when you look at the sources of finance for this diversification, it's purely equity. So I was still thinking, do you really need to, at the level of the cost of equity, is it not enough grant to benchmark the 50% instead of start getting the weighted? Since they have stated that the process is going to come from equity issue of right issue to the shareholders.
Okay, now let's quickly go back. Now, this weighted average cost of capital is for the company, not for Prezi. Dari, this weighted average capital is for the Prezi, is for the whole company, for the main company, not for Prezi. The main company has all this debt. Look at their debts. This is it. The weighted average cost of capital is not for Prezi company. You can see that all the information that we use here.
What I was saying is this, sir. Are you hearing me?
I'm with you.
If you look at it, it plays the rules that this diversification is going to be financed.
I understand your diversification. We have done part of the diversification. We are through with that part. This is weighted average cost of capital, not for the weighted average cost of capital you are calculating is not for only for the diversification alone. It is for the main company as well.
Okay, I understand you. Understand.
It is not for the diversification. Okay. Now, the value of equity. We've calculated the value of equity already of the main company, right? We've calculated the value of equity already. Can you see them? We've calculated it here already. So I can copy this and paste here. The value of equity and the value of debt of the main company. So what is the cost of equity? That include the risk, which is 18% or 0.18. What is the cost of debt of the main company? Now let's quickly go back and check. What is our cost of debt quickly of the main company? What is the cost of debt? What is the cost of debt of the main company? 12%, right?
Yes.
12, yeah.
It's 12. Thank you. So it's actually 12%. Okay. Now, I'm seeing something here again. Now, TL loan stock 2027 to 2029 is 12%, right? And we still have TL proposed to finance the expansion of the textile to be 11%. Okay, that's fine. Okay, this will be for the textile, right? 11%. Okay. Yes, we'll use that one for textile. Okay, that makes sense. Let's move on. 12%. Right? 12%. And when you look at the 12%, it is not the 12% is what? The 12% is it post-tax or after tax? The 12%, is it post-tax or after tax?
They didn't
From the
mention.
question. I didn't mention it, so it is not after tax. So we have to consider, we have to do our tax relief, right? So when we have this 12%, 1 minus tax rate. What is the tax rate? 0.33. So what do we have here? What do we have? Class, what do we have?
0.08.
0.08. Class, are we still together?
Yes.
Okay. That's fine. So therefore, the weighted average cost of capital will be equals to, all our ingredients don't complete now. Is that not so? The value of equity to be 1,140. The cost of equity 0.18, right? 0.18. The value of equity 1,140. The value of debt 582. The value of debt 582. The cost of debt, we've calculated it to be post-tax or after tax, right? 0.08. The value of equity 1,140. The value of debt, to be 582. Plus, what is the weighted average cost of capital?
14.6.
0.146.
Is equal to 14.6. 14.6%. That is the weighted average cost of capital. 14.6%. Class. This is the weighted average cost of capital of the packaging industry, including the business risk of the diversification, as well as the financial risk of the main company, right? As well as the what? The financial risk of the what? Of the main company. This is the weighted average cost of capital or appropriate cost of capital. Now, don't forget that at the beginning of this question, we're told that they have two options. The first options for them is for them to say they want to expand, right? In the textile industry. If you want to expand, right, your risks still remain the same. Your risks still remain the way what? The way it is, right? For the expansion, class, for the expansion, the risks still remain what? Still remain the same because they want to do what? They want to expand. Now, if they want to actually expand into what is it called? In that textile industry, so we can now say what will be the weighted average cost of capital. You know, if they are expanding, they will just calculate the company, just the company weighted average cost of capital without including any risk, because they want to do what? They want to expand their what? Their operation class. So we cannot calculate so that we use it. Okay, what are the assumptions? Assumptions that you made? Please include the assumption. Number one, what is the first assumption that we assume that the nominal value of the debt is 100? Is that not so? We assume that the nominal value of the debt is 100. Then the tax given to us is assumed to be for the three company. So you can state your assumptions like that. Now, before you can compare whether this 15% is appropriate or not, you need to determine the weighted average cost of capital of the first one. We just did for the second one, which is diversification, both the business risk and the financial risk of the main company. It's included. Now, the next one is we should determine the weighted average cost of capital so that we now use it to advise if the 15% is appropriate or not not appropriate. Class, are we still together? Class, are we still together?
Yes, sir.
Yes, sir.
Okay. I knew you had that. Let me just test tie in expansion into textile industry. You know, they are in textile industry now. Is that not so? Now, we need to determine the weighted average cost of capital of that expansion, right? So that we will now use it, that 15% that they calculate, that is where we now look at it that, okay, is it appropriate or not? You know, we've calculated for when they are diversifying the packaging industry. Now, we need to calculate for the second project, which is expansion into the textile. They are just expanding, they are not diversifying. So, the first thing we need to do is normal cost of capital. Is that also? With this, we are using the capital asset pricing model to determine the cost of equity of TL. Is that not so? So now let's do it this way. TL. So we need to calculate the cost of, we want to calculate the weighted average cost of capital. So the cost of equity given to us is CAPM. Is that not so, class? Are we still together? Is CAPM?
Yes, sir.
Okay, is it not CAPM? Okay, that's fine. As you are tired to meet, actually, I just want to complete this part and so that we can move ahead, please. So, or am I too fast? Am I too fast?
No, sir.
No.
Okay, that's fine. That's fine. So let's complete this part, please. So, what is the risk-free? We want to determine the weighted average cost of capital. We have identified the sources of finance, which is ordinary shares. Now, under ordinary shares, which method are we going to use? Is it dividend valuation or the capital asset pricing model? In all indicator, in all indication, in this question, is capital asset pricing model we have to use because all the ingredients to calculate capital asset pricing model is given to us. So, what is the risk-free?
6%.
Okay, just give me a figure. Risk-free is 6%. Plus, what is the equity beta? From the question. What is the equity beta? Okay, 1.2. Okay, Mukuna, just they feed me with question, the figures like that. What is the market return?
14%.
Okay, 14% minus 6. Cost of equity. What do we have?
15.6.
Okay, 15.6. 15.6%. So we can move to weighted average cost of capital. Is that not so? So before we move to the weighted average cost of capital, before we calculate weighted average cost of capital, we need to determine what is the value of the textile, right? Expansion into textile. Okay, let's check. Okay, if they want to expand into textile, what did they have? Packaging investment. Okay, they will have, this is what they will have, right? They will have this. Is that not so? If the TL proposed to finance the expansion of the textile operation with a 47.27 million, is that not so? What is the value of equity? We'll still do the same thing. Okay, that's fine. Now, hello, are we still together? Okay, that's fine. I'm coming. Just a minute. Let me check. Okay. Okay, let's stop there. Let's stop here so that you can digest others, right? So please, we'll continue from this expansion into the tester industry. Class, you should not forget what takes us to this part. We want to determine if the 15% is actually achievable or not, and we should state our assumption clearly. So in order to do that, we need to determine they have two projects. We need to determine the weighted average cost of capital for the diversification, which includes the business risk and the financial risk of the main company, then as well as the textile, the company itself, which is the test, including the textile industry, the expansion that they want to do, the expansion, which is the company itself, right? Want to do what? Want to actually what? Expand into another line of the what? They want to actually expand their what? Their operation. And you should not equally forget what are the lessons learned from this case scenario here. We're given two what is it called? Two proxy company. What do we do? Any day, anytime we are given two proxy company, please get the asset better of the two company and get the what is it called? The average asset better, then proceed to the next step. Right. In our next class, right, we'll complete this question. Then we'll solve more question. I think I will solve this question, which is question 5 in our next class. Question 5. Yes, this particular question was adopted from Pathfinder, 30 marks question. So I'll solve this question, 30 marks. Then any other question is your assignment, right? Any other question here are your what? Are your assignments. So you just have to do it and send to the platform. Please don't forget that grace does not work in an isolation. You just have to put in an effort. As you are tired, you can see I've been sitting down here since 12 p.m. and 12 noon, and this is 2:49. So as you are preparing for the exam, I'm also preparing. All the tutors are also preparing because we need to put things together. We need to look for a way to actually deliver the lecture. We need to look for material. We need to think outside the box, right? So please put in effort. If you say you cannot come and kill yourself, well, if I want to do that, by this class supposed to end 2 o'clock now. I'm supposed to just say, okay, now our next class will continue. But no, say no, we have to complete this because of our time. Don't forget that we don't have enough time anymore. We have a limited time and we have a lot to cover, right? So from this project specific cost of capital, we will move to investment appraiser because that is another function of a financial manager. When you source up for the finance, then you discount it. You already identify the project. You discount the project with the appropriate cost of capital. So we'll move to investment appraiser. From investment appraiser to bond valuation. Then from bond valuation, we'll spend more time to the valuation of a business, talking about the free cash flow, the markets, what is it called? Yes, free cash flow to the firm, free cash flow to equity. The other method of evaluation of a business, right? So from there, we move to merger and acquisition, from merger and acquisition to reconstruction and reorganization. From there, we move to the risk management, talking about the foreign exchange and international investment. Adjusted present value is still there, actually. So you can see that we still have to touch. We still have a lot to touch. So thank you so much, everyone. Just go back to the video. It's already on the YouTube. Go back to the YouTube. Watch it again. Make your notes. Write something. You must write. Understand? So thank you so much. Do you have anyone that have question before we go? Quickly.
Sorry, sir. Did you say bond valuation?
Yes.
I thought I removed it from the syllabus.
Check now. Check now.
My bond valuation and portfolio theory was removed from the syllabus.
Did you check the syllabus? Did you
I
check
just
it?
saw. I'll go and check. I'm going
Go and
to.
check. It's only the portfolio theory is to FM. The portfolio theory is to FM, right? So the bond valuation is still there, right? So when we have the modified duration, it was still there. If you check the syllabus, the new syllabus is actually there. So our portfolio theory is one of my best topic, but they've moved it to FM. So thank you. Do we have anyone that have question before we go? Don't forget, grace does not work in isolation. Oh, please, everybody have to put efforts. If you want to pass, if you want to do anything, even in life, if you want to do anything successful, you just have to put in your effort and everything you get. So I think we have to go. So thank you, and have a wonderful weekend. Thank you. Thank you.
Thank you, sir.
Thank you. Thank you, sir.
Thank you, sir.
Yeah, thank you.
Thank you, sir.
Thank you. Yeah.